So Jerome Powell and the Federal Reserve came out last Friday and they said we are going to see inflation go above the targeted 2%. Now what does this mean, and what's going to happen in the economy, and how can you protect yourself against inflation? Well, stick around to the end and I'll give you my thoughts and tips. So the Federal Reserve targets inflation of 2%. And looking back since the 1980s, you can see in this graph, the Fed has done a pretty good job of maintaining this, at least since the mid-90s. We all know Jerome Powell, he's been cranking that money printer. It's overheating, man. He can't stop. Will this have major fallout on the economy? Well, that's yet to be seen. But yet, as they're printing more money, this dollar is becoming worth less and less. This dollar bill, it's a dollar bill today, and tomorrow it's still going to be a dollar bill. And 10 years from now, it's still going to be a $1 bill. But over time, it's going to become worth less and less, and it's going to have less power than it does today. And that's inflation. During the 1970s, the US went through a period of what's known as stagflation. Overall, the US saw a rise of inflation from 1.6% in 1965 to over 13% by 1980. Overall, this was a tough economic time for the United States. This period saw not only rising inflation, but high unemployment numbers as well. And it was brought on because of the oil embargo in the early 70s. By the end of the decade, this hard hitter with the cigar, who was the Fed chairman under Ronald Reagan, his name is Paul Volcker, he set a rule that the Fed will have followed up until this day. He said the number one goal of the Federal Reserve is to target inflation, and that number should be around 2%. So now with the Federal Reserve coming out and saying unemployment is a greater concern than inflation, that totally changes the playbook on what we've seen over the past few decades. Over the next few years, we can expect to see the Federal Reserve maintain expansionary monetary policy. This means we can expect rates to stay low for some time. Yeah, you can be excited to see a lower APR on your credit cards. You can get a better deal with the mortgage right now. And hey, right now is probably as good a time as ever to refinance if you haven't already. It is possible, however, that the inflation will put upward pressure on rates, particularly when talking about short-term debt, and would probably be less likely to impact mortgage rates. Now, what should we be doing to protect ourselves against inflation? Well, first let me say I'm not a financial advisor, but I can tell you my thoughts and what I'm doing. And if you've enjoyed this video, please don't forget to give it a like. The first way you can hedge against inflation is to keep your money in assets like stocks or real estate. The prices of assets will naturally rise as inflation occurs in the economy. But wait, isn't the stock market headed for another crash? And with all this forbearance and looming foreclosures and evictions coming up, isn't the real estate market headed for a downward spiral? Well, yeah, it's certainly possible. That's why I'm going to give you 5 alternative ways to hedge yourself against inflation. First, well, let's look at the godfather of investing, Warren Buffett himself. He just invested into Barrick Gold. Now, I know you're thinking gold is a commodity, right? Well, actually, Barrick Gold, what Warren Buffett invested in, is a gold manufacturing company. But nevertheless, they're heavily weighted on the price of gold. So if you're interested in investing in gold, this isn't a bad way to do it. The second way you can hedge yourself is by investing in commodity ETFs. Now, I don't do this personally, but in the description, I'll link a site that lists a number of different commodity ETFs that are available to invest in. A third way you can hedge is a more conservative investing approach. I don't know if any of you guys use Betterment or Wealthfront, but there they have a little toolbar you can shift on how conservative or aggressive you want to be. Now, the more you move to the conservative, the more you're investing in different bond ETFs and less in stocks which are less volatile. So if the market goes through a big downturn, you're going to be less impacted. But these will also keep their price steady with inflation. Now, the two ways that I'm hedging myself against inflation, well, first, cryptocurrency. Now, cryptocurrency can be risky, and I would advise if you invest anything in cryptocurrency, you should be okay with losing this money too, because you can never know what happened to these. I mean, it's unlikely they'll probably go to zero, but yeah, like in a week, you could see it lose half its value. So this is extremely volatile, but this can be a major hedge against inflation. We've seen hedge fund managers shift their mindset on this, and now you can see some are investing as much as 3 to 5% in cryptocurrency. Now, if you're new to cryptocurrency, I would stick with one of the most notable coins like Bitcoin or Ethereum or Ripple at first. Since the supply of these coins are finite, as inflation happens to the US dollar, you're going to see the prices of these cryptocurrencies naturally rise because their supply is finite. Now, there could be other factors that could throw that price downwards, but cryptocurrency also have huge upside. So coupling that upside with the hedge against inflation, I feel comfortable investing about 5% of my portfolio in cryptocurrency. And the fifth tip to hedge against inflation, well, it's tips. I'm talking about Treasury inflation protected securities. These are essentially Treasury bonds issued by the US government, but they're protected and adjusted for inflation. An example of this, you can look up ticker symbol TIPS. This is an iShare ETF of these Treasury bonds that are protected against inflation. Now, I consider this a good alternative to having your money in a savings account that might be earning 0.8% interest right now. Overall, this is my strategy to hedge against inflation. I still think investing in assets, whether it be real estate or stocks, can be a good investment if it makes sense. So I won't hesitate to do that. But as far as the money that you're keeping on the sidelines, if you want to see it outperform inflation, I would consider one of those 5 alternatives. I hope you guys enjoyed this video. If you'd like to see more of these videos, please consider subscribing. It will help my growing channel. Thank you.